Hi everyone, welcome back to our video series titled Investing 101 with Dr. Peng. Joining with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi Dr. Peng, it's a pleasure to have you back.
Hello, hi everyone.
So just to recap, in this 5-part series, Dr. Peng and I will be talking about important investing concepts, namely inflation, equity, bonds, gold, and expected returns. In the first episode, we talked about inflation and its impact. And in the second episode, we talked about investing in equities. Today's episode will be all about bonds, right? So Dr. Peng, let's just jump right into it. So what is a bond?
So bond may sound a little bit foreign to investors, but the basic logic is really lending and borrowing money. And so we all know about lending and borrowing money, right? Whether it's between individuals or between companies or government also sometimes borrow money. Now, bond is basically a standardized form of borrowing money so that people can easily price it and trade it with each other, trade it in the market. So bond, if you can use in simple terms, the way I would explain it is that bond is basically the standardized way of lending and borrowing money.
Right, so essentially you lend money to, say, a government or a corporation,
right?
And for that they pay you an interest, and that's the return that you get.
Correct. From an investor's perspective, basically you're lending money by buying bonds issued by different entities, right? Typically it's government or corporations, and in return, like you said, they pay you interest, and at the end of the bond, when the bond matures, you're also expected to get your principal back.
So Dr. Peng, what is the role that bonds play in investing? I mean, we get the concept that, okay, you're lending money, you get a return, but how should we view it when we look at our portfolio?
If you look at the overall portfolio, there's really three main asset classes in my mind. One is cash. It's really for short-term investing, short-term liquidity, doesn't really generate too much of returns over a long period of time. Then we talked about equity last time, and equity is really participating the company's operations and participating in the profit loss. So it has more upside, but also have more downside and risks. We talked about that. But bond is something in between. So bond, because of the nature of the bond, is borrowing and lending money, and there's a promised interest that you will receive periodically. And so unlike stock, many times you may not get any dividend payment. Bond, in the sense, actually, when people invest in bonds, another term for bond is called fixed income instruments. And so that kind of tell you a little bit that bond is relatively stable in the grand scheme of things compared to equity over a long period of time. So when we invest in bonds, there's a couple roles bonds provide. One is it generate income, right, over a period of time. And then secondly, it's a stabilizer in the portfolio, help stabilize the high volatility that a stock portfolio brings.
Yeah. So maybe we can talk about why bonds, as you mentioned, is more stable, is safer. So, for example, if could you explain, like, let's say a corporation collapses, right?
Mm-hmm.
So how would their assets be distributed?
Sure,
and which
sure.
Would be prioritized?
Sure. So you're exactly right. As part of the prioritization in terms of borrowing and lending, compared to stock, why bonds are more stable? Number one, the interest payment is prescribed when you bought the bond, right? So it's relatively fixed, right? So that's number one. Number two is that when a company or a government or the borrower is in distress, meaning that their financial situation worsens, they may not be able to pay back the bond or stock investors, then they need to prioritize pay back the bond investor first, the interest as well as the principal, and before they pay anything back to the stock investor. So in that sense, bond is less risky and more stable, and became a long-term stabilizer in the overall portfolio.
Right. So let's talk deeper about government bonds, right?
Sure.
So you mentioned there's government bonds and corporate bonds.
Right.
So what are government bonds?
So government bond is basically the borrower is the government, and they borrow money from individuals or institutions or companies because they need to finance the government spending. There's one very interesting aspect of government bond is that in any particular country, when the government issue bonds, they also have unlimited power of printing money, right? They can print paper currency. They have that power. And so in that sense, they will never run out of money. So even though their currency may devalue, may depreciate when they run into financial difficulties, but they will still be able to pay you back some nominal amount because they can print money. So in that sense, government bond do not really default.
Yeah. So let's say, for example, there is hyperinflation, right? But they'll just print more money. They will pay back what they obligated, but then whether it devalues the currency or not, they don't. It wouldn't really.
Right. Right. So they have this option of printing money and pay you back your principal and interest, even though the money they pay you back may be devalued or depreciated, but you still get some money back. So in a sense, we look at government bond, we say it's default-free bond because they will not default.
Yeah, so when we are looking at government bonds, we must make sure that, if as investors, we have to look at how stable the country is. So if we look at the US government or Singapore government, perhaps, when we look at all these, typically investors, we don't really have to worry too much about, this sort of thing happening.
That's correct. So if you look at government bond, even though that they don't default, but as their financial situation worsens, the probability of them not paying back and the bond investment value depreciate is real. So you definitely want to monitor the credit quality of a country and so on and so forth, and make sure that even though government bond doesn't default, your investment doesn't depreciate too much in a situation like you mentioned, hyperinflation.
Yeah. So government bonds are actually very stable to the extent that sometimes we call it risk-free.
Yes,
right? It's the risk-free rate in investing when we use the term.
And that's directly linked to how the government runs its fiscal policy. So for example, in Singapore here, the Singapore government bond enjoys a very high quality score, a very high credit score. And that's because Singapore government manages its spending very, very well and don't overspend. And so the credit quality is very well. So as a retail investor, when we invest in a government bond issued by the Singapore government or associated entities, that we can be, how do I say it? We can be more comfortable because the way that the Singapore government is managing their spending, they're limiting their borrowing to a very, very low degree.
So I would assume that for stable governments like the US and Singapore, the interest rates would be lower compared to, let's say, you were to buy a government bond from a government, maybe a government.
Greece. We have heard for Greece for a long period of time. So that's a country where the government doesn't do as good a job managing their fiscal policy. They tend to overspend, and over time they accumulate a lot of deficit. And essentially, when you have too much deficit, you cannot pay back. Essentially, the government bankrupt, even though they can still print money, but the bond invested into Greece government bond became much more depreciated.
Right. Okay, so let's talk about corporate bonds.
Right.
So we talk about government bonds, and essentially, as long as we look at most developed nations, maybe the G7 countries.
Yeah, so for Providend client, for investment purposes, when we look at bond investing, we typically focus on the really high quality government bond sector.
Yeah.
And also the high quality corporate bond sector, which we'll talk about now.
Yeah. So what's the difference then between a government bond and a corporate bond? I mean, I assume corporate bonds have higher risk of default as compared to government bonds?
Yeah,
Is there
so you
anything
can
else?
essentially consider that the only difference in terms of corporate bond and government bond is that the corporate bond, you're lending money as an investor, you're lending money to a company as opposed to a government. And so the company could do well or may not do well over time. And when they don't do well, then they have a risk of default. Or even if they don't have a risk of default, they may have issues paying back the interest and principal. So this risk and this added dimension is called default risk. And a complex the analysis when you're doing the investment in two ways. One is that we mentioned it's a additional risk, right? Yeah. But fortunately, with these additional risk, the market is fair. It actually rewards investors for taking on this default risk, and depends on how much this default risk. And if I want to further comment on this, probably some investor will ask, how do we manage this default risk, right? Yes, I like the little bit higher return, but how do I manage this? There's really two ways for investors to do that. One is to diversify. So rather than invest in one company's bond, we diversify across a number of companies, different industries, maybe even different countries to get that diversification benefit, which is always very important in investing. And then secondly, when it comes to default, again, just like we talk about different countries have different ways of managing their fiscal policy and their spending behavior, company has a similar, we can look at company the same way. So how does how healthy financially is a company? And for investors, for Providend investors, because the role we view bond mostly as a stabilizer in the portfolio rather than building higher returns, we tend to focus on mostly on high quality government bond and high quality investment grade corporate bonds.
Right, so let's unpack that a bit. So we always talk about bonds as a stabilizer in the portfolio. We believe that when we look at the research, equity gives higher expected returns, especially in the long run.
That's right.
But we still use bonds in our portfolios, right?
That's right.
And then you said that it's to stabilize the portfolio. So how does that work?
So you can envision that most of the time when stock market are not doing so well, actually bond, particularly government bond, does well or as is. So in a way, it doesn't move in sync with the equity market. So when the equity market not doing well, it actually tends to do better. So in this way, it stabilizes the overall portfolio. So you can think of your portfolio have two components. When one is not doing well, the other one is doing better, or as is. In that way, it stabilizes the overall portfolio's performance.
Right. So let's say if I have 50% equities, 50% bonds, let's say the stock market falls, right? And then now I will have more bonds than equities because bonds are more stable. Typically, when the stock market falls, bonds don't fall as much, or you may even
you may go up value. Yeah.
So during these sorts of period, we'll sort of do a rebalancing. So to get it back to 50-50.
That's right.
Yeah. So essentially, you're selling some of the bonds to buy equities at a lower price.
Yeah, you're selling high and buying low, essentially.
Yeah. And the flip side is true. So if equities go up,
that's right. That's right.
You have more equities.
That's
and
right.
Then you sell the equities to buy more bonds.
That's right. So it's a very disciplined way of keeping your portfolio in balance, and selling high and then buying low, and keep your portfolio stable and balanced for the long run.
Right. So if we look at the price, or rather the performance of this is a lot. You can say that the volatility is a lot less than, let's say, if you just go into 100% equity.
Correct.
Okay. Right. So how do we then choose between using government bonds or corporate bonds?
So there is, like I said, the corporate bond is really added a little bit dimension with the additional default risk, but also compensated with return. So when you look at corporate bonds, in a way, actually, if we manage the risk properly by diversify, by looking at higher quality bonds, we can actually, in combination with government bond, we can get a better risk-return trade-off. So to some degree, we don't want to ignore corporate bonds, and we want to use them to enhance the risk-return trade-offs of the bond portfolio and the overall portfolio to some degree. Yeah.
Right. Yeah, but not all corporate bonds not all bonds are equal, right? So there are such things such as high yield bonds, previously known as junk bonds, right?
Yeah.
Because we don't want our listeners to be like, oh, okay, I'm just going to buy a bond and it's
No,
relatively
no.
safe. So there are different.
Yes. So I think I mentioned it a little bit earlier regarding corporate bonds and the risk. There's really two things investors need to do. One is to diversify, and then number two is focus on the higher quality, higher credit score company issued bonds, the investment grade bonds, as opposed to the credit score not so good bonds. And so focus on those, and those over long term can help diversify a little bit more together with the government bonds, and also help diversify the overall portfolio.
Yeah, so to all our listeners, we have to just be more careful not to just chase the yield. So there are some bonds that will say, oh, we'll give you like 8-9%.
That's correct.
But the only reason why they are giving that sort of interest rates, right, such high interest rates, is because the risk of default is high.
That's correct. That's correct. So the market is fair. There's no free lunch, right?
Yeah.
So when you have a bond that's giving out 8 or 9%, when the prevailing interest rate right now, let's say, is 4%, the only reason they're willing to give you high interest is because they have difficulty of borrowing money, right? And their credit score is not so good. They're probably in somewhat a financial stress. And so you got to be very careful chasing these higher yield, because in the end, you might lose your principal.
Okay, thanks, Dr. Peng. So essentially, how do we determine how much bonds should we have in our portfolio?
In the overall portfolio,
Yeah.
It really depends on your risk appetite,
Yeah.
right?
There's a rule of thumb, that's quite, some people will just say use 100 minus your age, or 110 minus your age.
Right.
There are some rule of thumb there, but how do we make this decision rather than just depending on such rule of thumbs?
So I would say the rule of thumb really is try to capture sort of how much overall bond should be in your portfolio, like you mentioned. And this 100 minus age is really to say that if you're a young person, you have a longer investment horizon. Therefore, your ability to take on more risk is higher, right? So therefore, you should take on more risk. And therefore, this simple rule of thumb basically say, okay, if you're 25, then you should probably have 75% of your money into equities and then 25% into bonds. It's a rough rule of thumb. I mean, it to me, like I said, it tries to tell you, young investors have a longer horizon, therefore they can afford to take on more risk. They should have more equity in their portfolio. So that's the rule of thumb. And then in general, I think that works, although I wouldn't necessarily recommend anyone to just blindly follow that rule, but it sort of tells you the dynamic of investment horizon and how much bonds and equity in your portfolio.
Yeah, you brought up a point about willingness to take risks as well. So you can have the highest expected portfolio, for example, 100% equities, right? But in let's say during COVID or during
2008 financial crisis,
if you sold, if you can't take the volatility, right? Seeing your life savings, dropping close to half, right? Dropping in value by half. And you sell because you panic, right? Then even though technically, yes, you had the highest in the highest expected returns portfolio, but it wouldn't work for you if you're not able to stand the volatility.
Absolutely. So it's the average return. Yes, stock has higher average returns like we talked about, but it has a lot more volatility. So to be able to enjoy that higher return, you have to endure the higher up and downs in the market. And if you cannot, then those higher expected returns by investing purely in an equity portfolio is not really there for you, right? Because you cannot endure the up and down. So for most investors, it's actually healthy to have a part of their portfolio into bonds. Even for young investors, have a longer horizon, have a decent amount in a bond into the portfolio, really help stabilize the portfolio and help the investor endures the up and downs and be able to enjoy the long-term benefit of equity market more comfortably.
Right. Okay, thank you so much, Dr. Peng.
No
I think
problem.
That's all for this week's episode.
Okay, thank you.
Okay. To all our listeners, we hope that you found this discussion useful in understanding what it means to invest in bonds and the roles that bonds play in your portfolio. Right. So if you like this episode, please subscribe to our channel so that you don't miss out on the next few episodes where we will be talking about gold and expected returns. So as always, thank you for listening, and I'll see you in the next episode.
Thank you.
All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.